Bryce.
Right.
Hey, Daryl, how's it going?
Hi, good. How are you doing?
Doing good. Thank you for taking the time and hopping on.
Yeah, of course. Look forward to it.
Yeah, so we have a couple minutes. Whoop said give him about 8, 10 minutes.
Yeah.
So, is there anything that you guys have been thinking about since last time we spoke that's been spinning your wheels that you're like, I've been, wanting to ask this to Elliot. We are gonna break down a bunch of information today. Wolf is gonna present the presentation. We're just going to go in detail how everything that we do, everything about infinite banking, utilizing it, as a through the LLC, everything that I mentioned, how it actually will be structured, how it will work, and then how it can all tied to the trust. Since I know, you guys want to make sure that not also, you guys are also just building your wealth, but you guys are also protecting it.
Mm-hmm.
So that's awesome.
Yeah, I guess just getting more information about it. I've heard of infinite banking before and just this whole like insurance thing. I think just to see how the process works will help me understand it a whole lot better. And then funding it, obviously, right? I have an
Mhm.
insurance policy already. I don't remember what it is, if it's term life or whole life. I don't know. But I've only had it recently, and everything else prior to that has always been just it's always just been through my employer.
Okay.
So I guess it sounds to me like this would be like a new policy, right?
Yeah, so it's theoretically, if you already have a policy, let's say you have a term policy. Term policy is like renting. You're just temporarily purchasing it at a low cost, uh, paying a premium into it that covers you for a period of time, whether
Mm-hmm.
it's 10, 20, or 30 years. Typically, it is 30. And then there are a lot of good things that come with it, like living benefits that depends on your insurance and your carrier and all that stuff. Um, depending, for example, some of the carrier that I use, they give an accelerated terminal illness rider, so that's very very helpful, especially for women when it comes to it. At an age and time that they're most likely to get specifically like breast cancer and things like that. The insurance company will release up to 75% of the death benefit as soon as you receive that letter from your doctor that you're diagnosed with X. And whole life, if you already have a whole life policy, that's going to be a little bit better towards your favor because it's kind of like owning. Um, you're building equity, so you will be, if depending how long you've had it, if you haven't, especially also on the carrier and their insurance policy, if you already passed that surrender period, where you have already collected some type of funds in there, that what you can do, which basically would be a rollover, and transfer those funds into already a policy that would be structured completely different, but then it would allow you to allocate some of those funds and hard money that you have, worked so hard for that you put into, so you don't feel like you're just basically ending it and then starting a new one. Does that make
Mm-hmm.
sense? But if you're hypothetically, you're like, hey, I want to keep in place what I already have, absolutely keep those in place, especially if you want some guidance in regards to finding out the term whole life. I can guide you and help you figure out what exactly you have, so then we can pinpoint you, and then we can find those areas that you're not that you have gaps, right, that you're not protected um, with what you currently have. Then we can get you that protection. My goal would be get you more protection than what you have for the same, if not lower cost than what you're paying. Or if not, what you already have already in place, and that's the exact number you want. We're contracted with over 32 insurance carriers, so that would allow me to give you. Um, I have 32 different quotes. Besides, kind of like I'm like a life insurance broker,
Okay.
um, where it allows me to have the flexibility to see multiple carriers, companies, and give you my honest opinion on them and their history, how long they've been, active and stuff like that. Because to me, that is a big factor,
Mm-hmm.
especially one of the carriers that we use called Symmetra. They've been around for over 100 years. They're based out of Germany. So my idea is, if they've been passed through a few wars, a few pandemics, crashes, that's where I'm putting my money, right? So excited to dive in a little bit more. thank you for sharing all that. I will make sure um, that you fully understand, and I know you're going to fully understand the whole concept of it. And I know you mentioned you're a visual person, so there's a lot of diagrams and stuff there. So I'm excited to share with that. And then today, just so you know, there's no transactions. There's nothing that can actually even happen today. Today is just more educational. Let us give you all the information that I believe you should have, and then once you have an informed decision, then you can make an educated decision after.
Sounds good.
Yeah, let me text Wolf really fast. I think Wolf said he's gonna hop on here in a minute. Oh, there he is.
What's up, guys?
What's up?
How are you doing today?
Good. Hey, I'm so sorry. I know I'm 15 minutes late. I've been scrambling, like picking up everything, and it's been such a shit show. I do apologize, guys.
Don't worry about it. All good. We're in Hawaii time, so
Oh, okay. Nice,
Chill
nice.
time.
How's Hawaii?
warm, nice and cool.
sunny, breezy.
Can't complain.
Nice. I love that. I love that. How did you guys do after the event?
Busy. I
Yeah.
think we came back and we're just hit the ground running. So we got a lot of things happening right now. Trying to rebuild our house, trying to get one out of foreclosure, and it's just been a nightmare.
And putting
Oh,
our
yeah,
daughter
nice.
in college in Oahu.
Oh, have I missed anything in the past 15 minutes?
No, we're just catching up. Honestly, we're catching up.
Cool, cool, cool. Awesome. So, I know you guys are in the real estate space, right?
Correct. Yeah.
Dope, 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 dope. So, are you guys doing more to like short-term rentals or?
No.
We buy and hold everything for the most part.
Okay, cool, cool. How long have you guys been in that space?
Actively since 2023 is when we started really filling up our portfolio. So we started out with 10, I think, out in Kansas City. We sold one and then we flipped one. So we have 8 rentals out there, and we've got about 4 or 5 here, 2 that we're rebuilding on Maui. So we got quite a few. We manage everything on Maui, and we have a property manager out in Kansas City.
I love it. You know, I have actually one of my clients. He is here in Arizona, but he does have a bunch of properties out in Kansas City.
Mm-hmm.
It's interesting because I would have never guessed that Kansas City would be such a great market.
Yeah, same here.
I mean, yeah, the price point is perfect. So, for
You see what?
price point is perfect because
Oh,
the
yeah.
prices here in Hawaii and like kind of like California.
Yeah, that's awesome. Yeah, no, that's cool, man. So what's your guys' again long-term plan? Are you guys trying to acquire more doors, or what are you guys thinking?
Mm, I think we're looking for a condo for our daughter for college, but probably after that, we're probably thinking of going into boutique hotels or
Nice.
multifamily.
Nice,
Just
nice. Are
trade
you
off.
guys looking to develop, or are you guys looking to just buy?
I guess either or, yeah, Joyce.
Both.
Yeah, both. Just offload our properties in the Midwest and just do something else different.
I love that. Yeah. So actually, some of the stuff that we do for some of our clients is on the real estate space as well too, on the financing. So we've done a little bit of financing for hotels specifically, or multifamily real estate. So definitely, I think there might be an opportunity for us to kind of do some business on that side, like down the line. So yeah, so I would love to kind of figure out a way to work together on different avenues and different ventures. So how much has Elliot told you guys about Sovereign Assets?
I mean, we've kind of gone through quite a few things, just the insurance portion and the wealth building part, infinite banking, and really, I just wanted for long term. I like the idea because we're growing, and I want to make sure that our our wealth is protected, and that we have something that's going to be that our kids can get and not have any issues with moving forward.
I love that. How many kids do you guys have?
We've got 2, one in college, one that's junior right now, so we've got a couple more years
Nice.
before we get an empty nest.
Yeah, that's awesome. I got a 6-year-old right now, so she's
Enjoy it.
Yeah,
yeah.
That same thing I
yeah,
told earlier. Just enjoy it.
yeah. They grow
Yeah,
up so
yeah, yeah.
fast.
She's awesome. She's like a little angel, you know. She's so smart. Like sometimes it's a little too smart for her own good, but that's how
Yeah,
kids are,
Yeah.
right?
yeah.
So, but yeah, no, I love it. So yeah, today we can keep the call like super simple, super chill. I like to kind of take things like step by step. You'll get to know us like we don't like to rush things, just because I feel like the moment you start rushing is kind of like when you start making mistakes, and especially in my industry in the financial space, the moment people start to rush things on my side. That means that there's an ulterior motive, or they just care more about the commissions that they're making
Yeah.
and all that stuff. You'll notice that there's no such thing as cookie cutter plans. We like to take a look at everything more in a holistic space, and like I said, make it a win-win situation for everybody. But yeah, so today, what I'll do, I'll go over a little bit of our process and kind of the things that we do dabble in, and kind of go over a few different concepts. We can take a look at some scenarios and examples, as well as what our clients have done in the past too. And then once I get back from Greece, I'd love to kind of dive in a little bit deeper into more of a strategy session. And then also, if there's an opportunity to partner up together, we operate out of partnerships all the time in a way that obviously if you know other investors, other high net worth individuals that are looking for something like this, why wouldn't we compensate you guys for a quality introduction, right? So I believe that a rising tide lifts all boats, and especially collaboration over competition, right? So
Love that.
let me go ahead and share my screen. And by the way, a lot of the stuff I'm going to go over with sometimes can be a little heavy. So if you do have questions, please stop me at any time. I don't want to make it in like in a word salad where I'm just like dumping on you. Please feel free to stop me at any point. Cool.
Sounds
Yep.
good.
Awesome. So I call this banking beyond limits, and the reason why is because I came from the concept of banks. There's a lot of banks. I mean, not a lot of banks. Every single bank out there does this. It's called fractional reserve banking. Have you guys heard of it?
Mm-mm.
Mm,
I've heard of. Sorry. I've been
No.
hearing fractional a lot lately, like fractional CFO, fractional ownership, but yeah, it's not too familiar with it.
Okay, no worries. Also, really quick, so I can't see your camera for some reason. You would think that Google had it figured out to like have a little like square on the side for the presenter to see you guys, but they don't do that. So if you're nodding or something, like I can't see you. So just unmute
Gotcha.
yourself.
Okay.
Sorry.
You can hear us though,
Um,
right?
yeah, I can hear you guys
Perfect.
perfect right now. Yeah.
Okay.
So cool. But yeah, no, you're right. So the fractional word has been what's called flown around quite a bit. But fractional reserve banking, what it does, it essentially it comes down with the idea that banks are able to lend out up to 9 times of your deposit. So think about it this way: every loan that's out there from banks, let's just say if Chase or Bank of America loans you $1 million, you can know for sure that they don't have more than 100 grand liquid for
Mm.
that million. So in other words, all the money that's being flown through the banking system is all fugazi. Like it doesn't really exist. They leverage your money 9 to 1.
Mm-hmm.
So that's why in 2008 you saw the collapse that happened because all the mortgage-backed securities essentially collapsed, and then there was a lot of over leverage in the banks, et cetera, right? So, anyways, what we want to do here at Sovereign Assets is that we want to fast track financial freedom by 30%. What does that mean? Well, we're using secure and tax-free growth. That way, you're not losing money or you're not paying too much in taxes, and we want to be able to have cash flowing ventures. The same way you guys are having rental properties and buy and hold is because I'm assuming you guys do like that cash flow that comes in from your property managers as well as your current tenants that you guys have in Hawaii. Also, we do participate in exclusive private equity opportunities. What I mean by that is more so like, and I'll go a little bit in depth for that, but private equity meaning buying companies and or buying shares of companies that haven't gone public in the stock market yet. So we do everything in one place, which essentially means that we're never going to refer you out to someone that we don't know. That's not somebody. Oh, I met this guy. No, like anybody that we're going to officially put our stamp of approval for Sovereign Assets, you can guarantee 2 things. Either we have done business with them, meaning that we are their clients. Like, for example, I buy gold from this guy here locally in Arizona. He's really good. So anybody that wants to buy gold, I refer them to him because I'm his client. But on the other side too, if we haven't done any deals with them, we've done extensive research through them. We have had a lot of references, and we've kind of seen them actually do deals. Like for example, Andrew, who's the senior partner for Sovereign Assets, I personally haven't bought a business from him yet. I'm still in the process of finding the right CPA firm that I'm gonna want to buy. He sent me a lot of business, and I've seen a lot of his clients that have bought and sold businesses through his firm. So again, the people that we're going to be putting our stamp of approval, those are going to be the people that we have done business with or we have done extensive due diligence on. So really quick, we have the Freedom Funders timeline. Now, Freedom Funders stems from the idea to fund your own freedom. Many Americans nowadays are kind of stuck in that idea that, oh, Social Security is going to carry me, my 401k is going to do it for me, the government is going to help me. And to be honest with you, that's a pipe dream. That's why, obviously, I'm assuming that's why you guys decided to become entrepreneurs and investors, because you knew that Social Security or a 401k alone is not going to cut it.
Yeah.
So we kind of believe the same thing, right? We do not want to rely on welfare. We do not want to rely on handouts. We believe that your own freedom, you should take over it yourself. Like it's your own responsibility. So where do we start then? We start with cash value life insurance policies. Why do we do that? Is because we want to have a horizon of at least 5 years, right? 1 to 5 years. Ideally, sometimes it can go up to 10 years or even longer than that, right? But ideally, to start using these policies, we want to have a horizon of about 1 to 5. But why do we use cash value life insurance? Well, because the foundation of a strong portfolio is going to be based on this asset that essentially acts as a cash warehouse. What kind of cash warehouse? Well, it's going to be tax advantage, which means that anything that you put in there, it's going to grow tax-free. And then you're going to be able to pull it out tax-free, and then it's going to pass down to your beneficiary or children, also tax-free. Number two, we are heavily relying on secure compounding. Why? Because secure compounding basically allows your money to grow uninterrupted from risk. So that's why these cash value life insurance policies are so powerful, because you can't lose any money. And then lastly, we want to maintain liquidity, because leverage without liquidity is stupidity, right? If you have a bunch of money in a place that you can't access, that you can't have liquidity to it, it's a stupid asset. It's an asset that's going to only be good for the long term. And then again, what if you die, right? You're not going to be able to have access to that, and you're not going to be able to enjoy the fruits of your labor. So what's the main asset that we're going to use against this cash value life insurance policy? Well, we're going to borrow money from ourselves. We're going to be the bankers and the lenders ourselves, and then we're going to go buy a business. Now, full disclosure, this is just a blueprint. It doesn't mean that it's the end-all, be-all. It's not a program that you buy into. It's simply like a step-by-step guide on things that we have currently done in the past, or that we're currently doing right now, or that we have taken clients throughout this. So the reason why we like M&A, right, or buying businesses is because and maybe you guys can speak on this. I mean, you guys have a lot more experience on actually investing into real estate. But I do know a couple of friends of mine who are very successful in real estate, and on average, they told me that it took them about 9 years before they could replace their current income. And that essentially means buying a house, rehabbing it, renting it, and then, refinancing later, buying another house, etc. So how long has it taken you guys to get to the point that you're in right now, where you know that your guys' bills are paid, that you guys don't require to go to a job, etc.? How long would you guys say?
I don't know. We're kind of in a unique situation where, his parents have a house that's got like $100,000 mortgage, and it's worth like $1 million. And they've got multiple units, multiple rentals. I mean, the rents here are insane. Like a 3-bedroom that's less than 1,000 square feet rents for $3,000. So I got that house, I got a mortgage for $2,600. I'm renting 3 units, so I'm taking in like 6 or 7 grand on that one unit alone.
Oh my God, good for you.
So I think it just depends. Like we have a variety. Over in Kansas City, they don't cash flow as much, but here on Maui, they're pretty darn good. So
That's awesome.
I mean, not just looking at numbers, but I want to say everything started for us in 2023. It's been about 2 years. I left my job in September of last
Nice,
year.
good.
And I think we're not banking tons and tons of money, but I think like our bills are okay.
I love that. Listen, I love that. And you know what? This is a good example of like, it's not like every situation, right? There are outliers like you. So this is awesome. By the way, congratulations, guys, because that at least in the Arizona market, obviously I live in Arizona. I live in Arizona, so the only people that I can take a look at is Arizona investors. So, but good job, because a lot of people here in Arizona, it takes them on average about like 5 to 9 years before they start cash flowing to a point because they've added so many properties. But then again, it sounds like you guys bought like multiple units, right? That have, you said like you have like 3 units.
Yeah. So
Yeah, it's a single family, but
yes.
you kind of spread
Oh,
it
it's
out where
really
it's like you gotta you can close the
Yeah.
garage, you
Yeah.
spread that out. Housing is such a need here. We
Yeah.
don't have land, so it's not like we have unlimited land to build. So people will rent a 1 bedroom or a 2 bedroom,
you
and
guys are doing like house hacking then.
correct.
Yeah.
Yeah.
I love that. I love that. You guys are very smart. You guys are very smart. So, yeah. So in that case, like you're probably even beating me to this because maybe that's something that we can start promoting to our clients as well. The only reason why I said to get into businesses and buying businesses is because on average it's gonna be the same process to buy a single family home than it is to buy a cash flowing business. With the only difference is that you're gonna be able to get a salary paid out from that business. Usually like 60 to 80K, and sometimes if you're lucky, you can get up to 100K salary from a business that you only have to work very, very part time, meaning like showing up maybe a couple times a week, if that, So, but with the idea that we're building this business, adding SOPs, we're adding automation, AI, etc., to where it increases the valuation of the business. And again, we do everything in house through Andrew at a Good Merger. And then from there, we want to sell it on the third year to a big private equity firm. And the reason why we want to sell it for private equity is because usually private equity will give you a pretty sweet deal, on average 3 to 6x. And what are you going to do with that money? Well, you can either rinse and repeat or do whatever you want. But I found that private equities happens to be a pretty good investment, meaning you can now invest into companies before they go public at a basically what is considered ground zero. So it's before they go public. So a lot of this time, what happens is that these companies will go public, and some of them will hit unicorn status. That's why you want to be able to work with a company that has the experience, that has the track record of taking companies to unicorn status, which essentially means at $1 billion or higher in valuation. Now, are you guys familiar with how private equity works, like the intricacies behind it?
Not really. I don't think we haven't got we have a business that we want to buy that's kind of in our radar right now, but the private equity side, no, we're not too familiar with it.
Yeah. Okay, no problem. So I'll give you at least two of the biggest challenges of private equity, right? Because um, first of all, I mean, aside from the fact that you got to be able to find the right deals to invest in, right? But the biggest problem with private equity is two things. Number one, you got to be liquid, and you have to be like the barrier of entry is too high, which means that you have to have about a couple $100,000 minimum to invest in, and you got to be an accredited investor. If you're not any of those, you really can't invest into private equity. Number two, the biggest challenge right after that is that where do you find a private equity deal, right? Where, like, do you go on Google? Do you go on Yelp? Do you look up investment banker? Do you ask ChatGPT? You can't. Like, private equity is one of those situations where you have to know somebody that's in it, or you have to be invited in. That's why it's called private equity, because it's private. So that's essentially where we're really coming into play, because we do have those relationships with those private equity groups that have taken companies public. Like, for example, if you guys want to look this up, Banner Cap, one of their managing directors, Cameron Tanner, he's a good friend of mine. He's out in Utah. He himself, or his firm, has taken 13 companies to unicorn, and they're currently right now raising capital for Routes, Manscaped, and IG Ram, which is like an aero defense company and stuff. So, anyways, they're raising capital for very strategic companies, right? So that's essentially where we come into play, because we can connect people with that. And yes, we have had clients that have invested in their companies, and currently right now they're on that like tail end to be able to finally go public. I think Manscaped should be going public, anytime in the next like 18 months. I had a client of mine a couple years ago that invested about $1 million into it. So the idea is like the problem. It's the reason why the barrier of entry is so high is because you're basically parking money there without really doing anything for the next 2 to 4 years, and sometimes it could take a little bit longer. But once it goes public, once the private equity deals goes live, that's when you essentially can make up to 12 times return on your money, right? So obviously it depends on the risk profile of each opportunity. The riskier, the higher the return. The lower the return, the more conservative the opportunity is. But that's not the end all be all. We want to now, once we've exited into private equity and we've made a bunch of money, we want to be able to get into multifamily real estate, right? So I mean, you guys are, you know, pretty good examples of that because you got, even though you have a single family home, you basically turn it into a multifamily property. So the reason why we like multifamily is because now you have multiple houses, multiple units, for basically the same price that would be to have just one building. You know, sometimes obviously it's going to be a lot bigger depending on the size of the project, but the idea is that it is cheaper to be able to develop a property and basically collect the rents on those multiple units than sometimes it can be from buying, you know, rehabbing, etc. Obviously, it depends on a deal by deal basis, but from my experience, from what I've noticed, and a lot of the developers that we do work with together, they bring us a lot of deals that they built from the ground up. You know, they sometimes they do some value adds and renos in there, but for the most part, they do multifamily real estate developments. We also do have some opportunities in Dubai, which I don't know how much you guys know about the Emirates real estate market. It is very lucrative and is very aggressive. Land alone, on average, appreciates on a 5x basis per year. Obviously, eventually that will slow down. So right now, it's a really good time to be able to get into Dubai real estate. Um, but anyways, so none of that stuff really does matter unless we have the last step already taken care of, which is going to be the multi-layer private express trust. Now, our secret sauce, guys, comes from us having the connections and the ability to be able to bring the law firms on the table, right? So we work directly with 1 out of 5 law firms in the whole country that do these type of trusts. I don't know how much you guys know about trusts, but there's thousands of different types of trusts. So having the right type of structure matters a lot. Our whole goal is that we want to be able to control everything without really owning anything. So you guys shouldn't have to have anything under your name. And obviously, being in real estate, I'm assuming you guys have each property under a different LLC, so you guys probably already doing that. So the next step would be having everything under like a holding company slash trust that owns everything else, and you as an individual being the executive trustee that controls it, right? So, any questions on this?
No, looks pretty good.
Okay, cool. This, by the way, this is the most dense slide that I do have, just because there's so many different steps, but it gives the foundation of what we're going to talk about next. That's going to be a little bit more lighthearted. But I just wanted to at least show you guys kind of like what our timeline is, right? We don't believe in overnight success. Listen, I've been doing this for 10 years, right? And like, even for me, it's taken me like quite literally 10 years to get to where I'm at today. And it's because I believe in consistent returns. I believe in consistent progress instead of home runs, because anything that comes really fast can also crash really fast. So I really believe in longevity. So that's why you'll see here that it says 1 to 5 years on the cash value, M&A 2 years, 1 year on the exit, 2 to 4 years on private equity, and then 1 to 2 years to stabilize a multifamily development. And the reason why is because I wanted to give people a realistic timeline on when to have financial freedom, which if you do the math on the long end, is going to be probably about 15 years, which is very doable, right? So that's why I wanted to at least lay the foundation of what we're going to talk about. So let's start with step number 1. And again, I'm going to be able to go through this pretty quick, but step number 1 is going to be secure compounding, or the cash value life insurance policies. And again, the reason why we use them is not really because they're like the holy grail or the next best thing since sliced bread. It's simply because it has really, really, really good benefits that a lot of people don't know about or just don't really understand. And one of them is the secure compounding. Again, that means that the growth of your money is never interrupted by uncontrollable risk or volatility, which I'll be able to show that in a little bit. But also on top of that too, that also means that you're not affected by any taxes. Now, I always tell everybody this is, don't just take my word for it. Go fact check me. Go to the IRS website. You'll be able to see that tax code 7702, 72E, and 101A is going to show that you can grow your money tax-free, you can access the money tax-free, and then transfer your money also tax-free. So again, right now we're solving 2 different issues. Risk, right, because we don't want to be affected by market volatility, and also taxes, right? So now we have an asset that grows without interrupting compounding cycles, and that's also not going to be taxable. Any questions on this?
We're good.
Awesome. So let's talk about infinite banking. I know Elliot might have briefly mentioned it, or you guys probably have seen it maybe on TikTok or something, maybe done a little bit of research. But how much do you guys understand about how infinite banking works?
No clue.
Not
No.
much. Yeah.
Uh,
I mean, I have heard of it, but
Yeah.
being your own bank, I think is what
Yes.
attracted us to it.
Yeah.
Yes, I love it. I love it. This is going to be great. So, infinite banking, I mean, it's a corny term, right? But it all comes down to using the same dollar twice, right? Like becoming your own banker. Why? Because you don't want to always be relying on the banks, right? Because if the bank has the money, they can make all the rules. But if you have the money, you can make your own rules. So, for example, I'm going to use like a glass metaphor to be able to illustrate it correctly. But again, the idea is that you're borrowing money at a discounted rate while the asset is still making money. So, for example, let's just say you guys bought a life insurance policy for $1 million. What's the guarantee of that? What's the promise of the life insurance policy?
Um, payment at death.
Exactly, right? So, regardless, if you buy a life insurance policy, the promise is that the insurance company is going to pay when you die, right? It's a transference of risk. However, there are other ways that you can use life insurance, and you can use it for essentially accumulating cash. So, for example, let's just say we do have this glass right here that represents your life insurance policy. Let's just say the glass itself, what's solid, is the actual death benefit, which means that it's not liquid. It means you cannot pull money from the death benefit. But what you can do is that this is a container, which means that you can put more money in there, right? So let's just say you pour water on this, and that water is considered a cash value. Now that cash value, on average, it'll do anywhere between 8 to 12%, obviously with a floor of 0%. So you can lose money, but on average, you're going to make about 8 to 12%. Obviously, that's nothing compared to real estate, because I know real estate does 24 to 48%. But again, we're not chasing high returns. We're chasing for passive returns that are going to be able to outperform inflation and stay on par with the market. So now let's just say that your policy, your cash value is averaging 9%. But wait a minute, this right here is still liquid, which means that if I open this up and I pour this, I can get my money out, right? I can liquidate my account. Instead of liquidating your account and paying taxes on any interest accrued, what you can do is that the insurance company is going to take a look at this and say, look, guys, Joyce, you are good for this. So if you die tomorrow, we're going to have to pay the whole thing to your beneficiary. So you can collateralize whatever's liquid in there, and then we'll just take it out of the whole pot whenever you do pass away. So for example, if you have a death benefit of $1 million and you have $1 million in cash value, the insurance company is going to give you a loan of $1 million. Now this loan right here is essentially costing you about 5%. So 5% in $1 million, that's 50 grand. That's what you should be paying to the insurance company. Or are they going to charge that out of your checking account? Are you going to write a check? No. Technically speaking, because they already owe you 9% on average, that's what they're going to have to credit your account at the end of the year. They'll just take it out of what they owe you of 9% and then credit you the difference. So two things are happening. Now your account that's leveraged has made 4% spread, tax-free, and you also have $1 million in your cash value that you can utilize to be able to, again, grow your assets investing in other things, right? So, here, 1 second. Give me 1 second. Somebody's at the door. Hey, bud, I'm on a call right now. Okay, do you need the keys?
You understand that, Luis?
Yeah,
Yeah.
I'm on a
You
call.
earn, you cost, so you're at 4% spread.
I'll see you later, bro. All right. So, does that make sense, guys, as far as infinite banking goes?
Yeah, I see the spread. Yeah.
Okay, cool. So, now that we understand how infinite banking works, the whole idea behind this is that now we want to be able to actually use this, right? It's not fun to retire when you're 60 or 70, basically when you're kind of at the tail end of your life. Maybe you have a hip replacement or whatever. You want to be able to enjoy your life now. I mean, obviously, you guys are living in paradise, so you guys are almost like living the retirement dream anyways. But for the average person, we want to be able to find ways to increase their portfolio, to increase their cash flow. So These are just four ways that I personally like to use infinite banking. Number one is going to be retirement planning, right? So again, if you guys are entrepreneurs, you know that you are responsible for your own retirement. There's not going to be a pension plan or a 401k plan that the government is going to give you, right? Number two is going to be tax reduction. If you guys have a bunch of businesses or you guys have an already existing cash flow in business, you can use corporate-owned life insurance to be able to be structured as an executive bonus plan, as a key man insurance. You can use it, for example, as a split dollar account. There's so many different ways that you can do it, where the money that you're going to have to pay the IRS anyways, you can pay it to yourself as a bonus or as a business expense, and then you can write that off. That's essentially what I've been doing myself for the past 3 years. And then you can also get into private lending. You guys are in real estate. You guys know this, like especially fix and flippers or even just like small time investors. They're going to need some money to be able to get into a property, whether it's earnest money, whether it's a down payment or closing costs, etc. Guess what? You can become that hard money lender. You can be able to issue microloans or be able to finance the whole thing. And you guys know this, hard money lenders, they're usually quite expensive, right? I mean, I think like a few months ago, the hard money lenders were charging like 13 to 15%, at least from what I do know in this market here in Arizona. But the beautiful thing is that you can essentially still put yourself as a competition for the average hard money lender and just charge half a point less, or charge a little bit less in closing costs, and you'll be able to stay competitive in that market. And what happens if the loan defaults? You have a lien on their property because you are considered the lender. Therefore, you can just take equity of their property. The other thing too that I like to do again is using it for M&A and real estate, right? So you want to be able to bank yourself. You want to be able to lend yourself the money to either buy the business outright or use it with the down payment to be able to essentially, like I said, finance the remaining amount. Does that make sense?
Yep.
Yes. Yeah. Yeah.
Now again, just because these are the four options that I put here doesn't mean that you can't use it for anything else. Like I said, my trip to Greece that I'm going tomorrow, I could have used my policy to do that for, right? So there's a lot of ways that you can do it. If you want to buy a car, you want to travel, you want to buy toys, whatever the case may be, you want to pay for your kids' college, you can use whatever you need for, whatever you need to use it for. So now that we understand the concept and we kind of went through that stuff, we're going to get into the meat and potatoes. And again, this is the stuff that's super important, right? Now, the first things first, I'm going to show you a nightmare scenario. Why do I show this? Very simple, because I like to show you the ugly first, because I want to, like, at the end of the day, if for some reason you're like, hey, I don't like this guy, he's a ginger, for whatever reason, I don't want to do business with Wolf or Elliot, at least you guys know what to watch out for, so that way, if you guys know anybody else, or you guys choose to go a different route with somebody else, at least you know what you're getting into. We believe heavily in education, so might as well for you to be able to know how these things work. So every policy is not built equally. Cash value can become a money pit or a scam if it's not done correctly, and everything falls down to structure. Just like in real estate, you have to find the right contractors, you have to get the right permits and be able to set up the right foundation in order for a building to last. Same thing goes from this. This right here is an actual real client, a real person that came to us with a pre-existing life insurance policy that was built for cash value. And you'll be able to start to notice a few things. Here on the right side, we're going to look at this column. The math is not going to start to math, and you'll see why. There are three main things that I'm always looking to achieve no matter what. Number one is going to be I want 90% of my cash value or the premium that I'm putting into the policy to go towards my cash value. So for baseline numbers, minimum, if I'm putting 100 grand, I want $90,000 to go towards the cash value, at least. Number two, I want to be able to have 50% liquidity or higher in the first to second year at the latest, depending on the goal of the policy. And then number three, the most important one, we want to make sure that we're breaking even within 3 to 5 years. And again, that math is going to be depending mostly on the age of the client. So obviously, the older you are or the closer you get to God, the longer it's going to take for the policy to break even just because of cost. But on average, most of the time, people are going to be able to break even within 3 to 5 years. So check this out. This guy is 24 years old, putting $3,000 a month into the policy. Look at the accumulated value, $24,000. That's not 90%. And if you look at the cash surrender value, 0. Okay. Year 2, he put 72,000, cash value 50, and the surrender amount or how much he has access to the policy, also 0. So right now, we are 0 for 0. Not a single goal accomplished. Maybe they'll break even within the third year. Nope. That's 108,000 went into the policy, 78 grand in cash value. So the guy's still down 30K. And how much access he has to the cash value? 10%. So not a good policy. Matter of fact, it's not until the 12th year that breaks even. So finally, after putting close to 430 something thousand dollars into the policy, he finally breaks even after 12 years. Now I'm going to ask you guys a stupid question. I probably already know the answer, but I'm going to ask it anyways. Is this something that you guys would invest in at this stage?
No.
Probably, right? And it's not really because cash value life insurance is a scam. It's simply just because of the structure of this is a bad investment. I wouldn't put any of my money into a vehicle that's going to take me 12 years just to break even, let alone start to make profits. So now that you know what not to do, let me show you what to do. So you'll see a much different type of policy. So again, this is from an actual investor perspective, real client of ours that puts 100 grand a year for the next 10 years. Right? So again, this is somebody that just wanted to have a 10-year policy, and that's it. Look at this, 100 grand went in, accumulated value, $93,000. So first goal of 90% plus accomplished. Net surrender value, which means how much access this person has to the cash value, a little bit over 50%. So second goal also accomplished because it's in the first year. And you'll notice that by year 3, 300,000 went in, and the cash value, 302. So now we've accomplished all 3 goals. Great, now we're off to the races. Watch this. In that third year, the client also borrowed $100,000. So not only he broke even at 302,000, but he did so while borrowing 100 grand out of the policy. So again, if you notice, even though he pulled money out, his cash value never went down. In year 6, 600,000 went in. He pulled another 100, so now he's 200,000 out, and the cash value did not go down. In year 11, again, he finally put the full million. He pulled out another 200, which means that he's 400,000 out. And look at this, his cash value, an additional 340,000. So not only he put $1 million into the policy, he also pulled 400,000 out
and made
during the first 10 years, and he still made $340,000 in interest. And now, in this situation, when you look at this, who is he borrowing money from?
Himself.
Exactly. He's borrowing money from himself, which means he makes the rules. He decides when to pay it back. After 12 years of having loans outstanding, now he decides he wants to pay them back, plus interest, by the way. So look at it. He's not putting any new premium. All he's doing is paying back what he borrowed, and boom. From year 11 to year 20, in about 8 to 9 years, he basically almost doubled his money. By not putting new money, all he did is pay back what he borrowed. So short term, we can probably agree it makes sense. What about long term? Here's when it starts to actually get really, really enticing. Because, for example, I wanted to compare it to traditional retirement age of 65 plus. So at 66, this person has about $4 million in the account. If you guys had a normal brokerage account or a normal traditional retirement vehicle, a good advisor would tell you that the safe withdrawal rate is 4%. So let's do a little bit of math there. If you had $4 million in a traditional retirement plan, and now you decided to pull out 4% of that,
160.
that equals to 160K, which, by the way, you have to pay taxes on. So let's just be conservative and say maybe taxes at that time is going to be 30% for the whole thing, minus 30%. You'll be netting $112,000 from a traditional retirement account. Now, am I saying that traditional retirement is bad? No. I'm just saying that if you want retirement income, traditional retirement vehicles might not be the best option. And why? Because right here, it shows you a very, very clear example that with the same amount of money, now we're pulling out 8% distributions free of taxes and fees. And you'll notice that this right here will go down for the next 25 years. Now, I'm being generous because the average male mortality rate is about 78 years old. But I wanted to try to crack the system and break it. And you'll notice that by the time the client turns 90 years old, he has pulled out $8.3 million in tax-free income that he doesn't have to pay back. Even though his loan balance is $12.5 million. These policies are built in order for you not to get over leveraged. That's why it's called the over loan protection rider. But watch this. His cash value is at 13.1 million. So if he were to pass away, his family would receive the total death benefit minus outstanding loans, which this will pay off, and then boom. You'll notice that now the family still gets $1.3 million in cash, tax-free. Is it starting to make sense on why a lot of people are starting to use IULs or cash value life insurance a lot more aggressively?
Yeah, totally. I've heard this multiple times by other investors, business people too. So
Yeah, no, that's good. That's good. So that means again, that means that it's the information is starting to really, really circulate out there. So now the last thing I'm going to spend the last 5 minutes basically just talking about like how our clients have done, because again, I would be very disingenuous to kind of sit here and talk all this big game and be super charismatic and all that stuff. But at the end of the day, if none of our clients have done any of the stuff and we don't have any track record to show that, it's not going to be good, right? At the end of the day, I like to show people real numbers and real track record. So this is one of the carriers that we do work with. They've paid over the past 5 years an average guaranteed locked rate of 9.8%. Does that mean that every client got 9.8%? No. But the clients that locked in their rate, on average, they locked it in at 9.8%. So we have one carrier right now that's able to guarantee returns for a lot of our clients at any point in time of their policy, that they can lock in their rate and guarantee that return. And that totaled to about $112 million in locked in gains. Here you'll see in June, 10.45%, in July, 10.83%, and then in September of last year, 8.64%, and then in September of last year as well, 10.17% returns. Now, this is before bonuses, because these 4 clients right here also received a 1% bonus on top. Now, again, when you compare this to what's out there, there's no vehicle out there that will give you a guaranteed 10% return on a tax-free basis, right? Now, again, I'm not saying that everybody should cash out everything that they do have, but it's more so to consider looking into things like this, because they do have really great performance. The cost is very manageable if it's structured the right way, and on top of that too, it is liquid, right? And it is tax-free. So these are 3 different clients. I always put this one right here at the first one, because I personally don't work with smaller clients anymore, but a lot of the times people think that they have to have a lot of money to start. I just wanted to show someone who's been working with us for about almost 4 years now. He's only putting about a couple $100 into his policy, but even then, he's broken even. He's about $3,000 ahead, but he has access to almost 100% of the money that he put in. Here's also another client that's put in $14,000 a year into the policy. That's about $56,000 in premiums. But this person, she's already at $64,000 in accumulation value, so she's already broken even. And the cash value that she has, it's again almost 90% liquidity. Here's also another client that the actual cash value is $141,000. He already borrowed $30K from it, and he still has access to about $41,000. So in this scenario, he would have about 50% liquidity from his cash value. The last thing I want to show you is this, right? So again, a lot of the times people say, oh, IULs don't perform, or they're capped, or they're too expensive. I already addressed the cost that it comes down to structure. I already addressed the performance that it comes down to picking the right options and working with somebody that has experience in this. And then number 3, when it comes to capped accounts, that's just simply a lie. Here's S&P 500 index blend, 2-year index, 46.72% return uncapped. In 2 years, the S&P 500 on this policy did 46.67%, also uncapped. Here's also another 2-year index, 38.78% uncapped in the S&P. What happens when the stock market crashes or the market is negative? Nothing at all. Our clients begin at 1936, negative 3.62, negative 2.89, boom, no losses. Here's also another client that has about $900,000 in the cash value. She has about a little bit over 60% liquidity from her cash value. Here's another one that has a cash value of $40,000 with a liquidity of about almost 80%. Right? So I want to be respectful of your time, because I know we got this until the top of the hour, and it's in about a minute or so. So I wanted to kind of leave it out here because that's it. That's the whole process that we do have. Any questions that I can ask for you guys?
Think about it like two wallets. You have one that's your death benefit, no matter what you are going to
Right.
get in case you pass away, and then you have another wallet that you can borrow from it at any point. Just kind of like some wallets, the old school ones have
Yeah,
the coin
yeah.
pocket with the zipper.
Yeah.
Like at any point you can say, "Hey, I need to borrow from it and utilize it for X." That's
Okay.
the way I kind of think.
And what is the surrender value?
Say it again.
What is the surrender value?
The surrender value is technically the liquidity pool. So, and they call it surrender value because if you wanted to cancel the policy entirely,
Yeah.
that's what you would get out. So,
I see.
that's why they have to call it like that because the loophole of the tax-free money is that it's considered a loan, right? Unless you cash it out or surrender it, now you got to pay taxes on whatever interest you earn.
Okay. And then the other thing that I was trying to think is, because obviously soon we do have a lawsuit that's happening with the fire. And so instead of doing like these annual contributions, I don't know if there's a limit to that, but if you had a large pool of money that you wanted to put into this, seeing the structure is good and you get 50% liquidity and all that, is that something that you could do?
Absolutely. It all comes down to structure, and I think we've had clients that sold their business, and what they wanted to do is like they wanted to do a 5-year policy, and for example, put like $5 million into it, into like a premium deposit account. So in essence, instead of you keeping it in your bank account, it goes into like a savings account from the insurance company that's earning 6% guaranteed, and every year they pull $1 million, $1 million, $1 million until it's fully paid out within 5 years. So yes, we can totally do that too.
Awesome. Okay.
So let's do this. I know I got you guys a lot of information, and I'm sure you got to have a ton of questions, and you want to do your own due diligence and all that stuff. And I highly encourage people to do so. I'll be in Greece until the 23rd. I would love to get back on a call with you guys and maybe kind of run through some scenarios. Where we can plug in your date of birth, we can kind of plug in some numbers for you guys to kind of play around with. And then from there, like I said, we can take a look and see if this is a good fit. I personally think you guys are going to be able to really take advantage of this, and you guys are going to love utilizing this. But again, that's going to be completely your decision. So we won't know until we run some numbers. So, but yeah, really quick question. How do you say your name?
Daryl?
Daryl?
Yeah.
Okay, sorry. I looked at the invite, and the way that it was spelled, I was like, man, I want to say his name, but I just don't want to butcher it.
It honestly, it threw me off too until he first introduced himself. He said Daryl. I was like, oh yes, okay. So it's exactly how I was saying it.
I said Joyce's name, but I didn't say that. I promise I was not being disrespectful. I just didn't want to butcher your name more than anything. So
happens all the time.
All the time. That's
Since
okay.
we are all on a call, I want to make sure we get the next schedule set up. Are you guys available the 25th on a Thursday?
That's September. Yeah, that's fine.
Okay. We can do around the same time, 2 p.m. I'm looking at Wolf's. He does have availability at 2 p.m. You want to confirm that, Wolf?
1 second.
Thursday the 25th. I know we do have the gala.
At 2 p.m.? Yeah, that's fine. Yeah, I got it. You want to block out another hour?
Yeah, if they're available, just
Yep, that's fine.
Let's do it.
Perfect. Let's do that.
Cool.
And then
All
one
right,
more
guys.
question. Sorry, just so we, so we're clear. We have our own other insurance policies. Does that even matter? Like, just leave it alone, or?
Yeah, you guys can. I mean, do you want us to take a look at it? Like, because a lot of the time the policies haven't been set up correctly, so maybe we can upgrade them for you without really having to do much on it. So if you want, could you send those policies to Elia? We'd love to take a look at them for free. We're not gonna and it could be like non-obligational, but we'll take a look at them.
Yeah, that would be great. I think I had a more question on his because he's had his for like, I don't know, 20 plus
Forever.
years or so.
Yeah.
But
Oh,
his
wow,
has a
nice.
cash value. In the last I looked, I was like, that's it. So I don't know if it's structured right.
Probably not. Then.
Yeah.
Okay.
Yeah.
Yeah. Send us the statement. Send us both of you guys a statement, and let's see if we can upgrade them.
Okay, sounds good.
All right.
Awesome. All right,
Enjoy-
guys.
Thank
Enjoy
you
your
guys. Enjoy
vacation.
Greece.
Thank you, man. I appreciate it.
Bye, Ellen.
Okay.
Thank you.
Yeah.
Yeah, did you ever see your last policy?
Nope.
You've had it for like 20 years and no cash value on that is 100,000. I was like, for 20 years?
I know. I don't know. I have no clue this way. How for do it at shit.
I don't either. I have a 2 o'clock appointment. So you can drop me off
Where?
down at the cannery.
Wait.
My haircut. The guy who paid me to get a haircut.